Learning Objective 7 is to compute the margin of safety and explain its significance. The margin of safety in dollars is the excess over budgeted or actual sales over the break-even volume sales. See the picture here. For the formula here, we use total sales minus break-even sales. The margin of safety can help management assess how far above or below the break-even point the company is currently operating. The greater this margin, the less sensitive the company to go bankruptcy. Let's take a look at RBC. If we assume RBC has actual sales over $200,000, given that we have already determined the break-even sales to be $200,000, we can easily calculate the margin of safety in dollars as the difference between actual sales and break-even point, $50,000. We can also calculate the margin of safety percentage. RBC's margin of safety can be expressed as 20% of sales. We use margin of safety in dollars divided by total sales. This is actual sales for RBC, $250,000, and we can get 20%. The margin of safety can be expressed in terms of number of units sold. To calculate margin of safety in units, we can use margin of safety in dollar amount divided by selling price per unit. For RBC, the margin of safety dollar amount $50,000 divided by 500 selling price per bike. And we can get a margin of safety in units for RBC 100 bikes. Learning Objective 8 is to compute the degree of operating leverage at a particular level of sales and explain how it can be used to predict sales in net operating income. Operating leverage is a measure of how sensitive net operating income is to percentage changes in sales. It's a measure at any given level of sales of how a percentage change in sales volume will affect profits. This is a formula to calculate degree of operating leverage. We divide the contribution margin by net operating income. Let's still use RBC as an example. This is RBC contribution income statement. We assume actual sales 500 bikes, and we have total sales minus variable expenses, and we can get contribution margin. Minus fixed expenses, net operating income is $20,000. Now to calculate the operating leverage, we use 100,000 contribution margin divided by net operating income. The degree of operating leverage is 5. Well, what does it mean? It means if RBC increases its sales by 10%, net operating income will increase by 50%, which is 10% increase in sales multiplied by degree of operating leverage 5, and we can get 50% increase in profit. Let's take a look at the verification. Actual sales 500 units, so total sales dollar amount $250,000. If total sales increased from 500 units to 550 units, which is 10%, total sales dollar amount will increase to $275,000. Remember, variable expenses per unit for RBC is $300, so we use $300 multiplied by 550 and we can get 165,000. This is total variable expense. And the difference between total sales and variable expenses is contribution margin. Fixed expenses, constant. Net operating income will be 30,000. Compared to 20,000 here, net operating income increased 50%. 30,000 minus 20,000 divided by 20,000, which is 50%. Learning Objective 9. What if a company has more than one product? And let's take a look at contribution margin and break-even point. Sales mix. Sales mix is a relative proportion in which a company's products are sold. Different products have different selling prices, cost structures, and contribution margins. When a company sells more than one product, break-even analysis is more complicated. And we will still use RBC as example, but now, in addition to selling bikes, RBC sells cards. And we assume the sales mix between the two products remains the same. Let's take a look at the calculation. RBC provides the following information. For those two products, bicycle and cards, we have total sales number, variable expenses, and total contribution margin, respectively. And then we also have variable ratio and contribution margin ratio for bicycles and cards, respectively. For total, we have total sales, 550,000, total variable expenses, and total contribution margin. For fixed expenses, you can see here 170,000. We will not assign any percentage to those products. Net operating income, 95,000. Let's first take a look at the sales mix. This is a percentage of sales of each product to the total sales. We have sales of a bicycle, 250,000. We use 250,000 divided by total sales, 550,000, and we can get 45%. For cards, we use 300,000 divided by 550,000, and then we can get 55%. So for sales mix, bikes comprise 45% of RBC's total sales revenue, and the cards comprise the remaining 55%. Now let's take a look at contribution margin ratio for those two products. Here, based on the total here, we can use total contribution margin, 265,000 divided by total sales, and then we can calculate contribution margin ratio, 48.2%. This is a rounded number. If we want to get dollar sales to break even, this is formula method. We use fixed expenses divided by contribution margin ratio. For total here, fixed expenses 170,000. Contribution margin ratio for the company 48.2%. And we can get dollar sales to break even $352,697. And now let's take a look at for each product, total sales, variable expenses, and contribution margin expected to achieve break-even point. Here, total dollar sales to break even, we put in this column because this is total, 352,697. Keep in mind, sales mix remains constant, which means total sales of a bicycle should be 40% of total sales, and the sales of cards should be 55%. So now we can calculate break even for bicycle sales should be total sales here for the company multiplied by 45%. And then we can get 158,714. For cards, we use total sales multiplied by 55%, and we can get 193,983. This is dollar sales to break even for cards. And then based on the variable expense ratio and contribution margin ratio, we can calculate variable expenses, contribution margin, respectively for bicycle and for cards. Let's take a look at the total column here. We have sales minus variable expenses. For this number here, you can either add up variable expenses from bicycle and cards, or you can just use the ratio here. This is variable expense ratio for total to calculate 182,501. The difference is contribution margin, and this is 170,176. Fixed expenses 170,000. Well, theoretically, net operating income should be 0 because this is a break-even point. However, because total contribution margin in the beginning we calculate 48.2%, this is a rounded number. So we do have a rounding error, 176. This should be 0. In this chapter, we focus on cost volume profit analysis. We do make assumptions during CVP analysis. Number 1, we assume selling price is constant. Number 2, costs are linear and can be accurately divided into variable and fixed parts. Number 3, in multi-product companies, the sales mix is constant. Number 4, in manufacturing companies, we assume inventories do not change, which means units produced are same as units sold.